Morning, everyone. Welcome you to our monthly UTI Market Insight, where I will take you through an overview of the fixed income markets, and we'll be very happy to address some of your questions and concerns at the end of this presentation. So, kickstarting the market outlook, let's just focus on the global trends because this clearly has been a big determinant of how Indian fixed income markets are also behaving. And I think the lead indicator that everyone has been watching for, and this is a chart that we've been putting up every month just to show the trend, which has turned quite favorable for fixed income markets. So the headline inflation across most of the developed economies has actually been trending down, and this momentum and trend actually continues well into April as well. The only exception to this is the orange line that you see in the top, which is actually United Kingdom, where inflation has sort of been sticky at around 10%. That's headline CPI, and has not really seen the level of disinflation that maybe some of the other larger economies, including the EC, Euro region and the US has seen. So this clearly has brought in some respite in terms of the broader interest rate outlook. The latest print, which as of April end was for the month of March, does show a significant decline over the peak that we had seen in the months of June or October for various different economies. The only concern I would say at this level is that while moderating and we expect it to continue the current trend, the core inflation somewhat remains still some sticky, although it is declining as well. But it's really been a lot more sticky than what we have witnessed as far as the headline inflation is concerned. In fact, this pattern is pretty much evident across, different economies, particularly even in India as well. And we'll come to that a little later. The key driver, I guess, continues to be part of the fact that there is a significant decline in commodity prices. So if you look at the commodity index on the left-hand side of this chart, you would see that it continues to show a downward sloping trend with intermittent bounce of commodity prices moving up, reflected in this index. But the biggest determinant here clearly has been crude, and that has continued to see prices decline. In fact, it's not yet reached the previous highs that we've seen. And this is positive, particularly for India, when we look at the Indian inflation story. Food as well, food actually has seen a significant disinflation. And this sharp negative number that you see in the more recent months has been driven by a very significant decline in the vegetable oil prices. So broadly, the drivers of commodity-led inflation are trending down and continue to support headline inflation decline. The concern, I guess, is still around services, which has seen some level of deceleration, but not significant enough to drive up core inflation down. On the growth front, if you look at it, global growth continues to remain soft. In fact, if you look at the global manufacturing PMI, it remains in somewhat contractionary zone, with the monthly numbers printing well below 50. A small uptick, which we saw in February, but again, it's sort of started coming down. So broadly, there isn't any great expectation as far as the manufacturing segment of global PMIs are concerned. So in a way, indication of the fact that there is some degree of slack building up as far as manufacturing sector is concerned. This is also reflected if you look at the global trade, both in terms of the volumes that we see are now sort of trending down closer to near zero levels. And this is in many ways reflected in the latest global growth outlook given by IMF. In fact, they have been notching up growth downwards in all their serious sort of sequential outlook reports. And as of April, you would note that the growth outlook for the current year, which they typically look at the calendar year 2023, is almost 60 basis point down for the overall economy. However, it sees a slight uptick for 2024, which is the next year, by about 20 basis point. But what's more notable when you look at this chart is the fact that most of this global growth decline is actually led by the advanced economies. So, you've seen almost growth halving from 2.7% in 2023, and maybe somewhat remaining flattish into the next year as well. And this is also to some extent reflection of the kind of rate hikes we've seen, followed through by most of the developed market central banks. The more positive feature of this growth outlook for global economy is clearly the fact that when it comes to emerging markets, particularly, economies like India, When you look at the aggregate global sort of growth for these emerging markets and developing economies, you're not seeing that sharper decline that we witnessed for the advanced economies. So, just about 10 basis point decline for 2023, and actually inching up to even grow faster than where we were in 2022. So, some degree of optimism when it comes to the EMs. The big event, I suppose, in the month of May was clearly the Federal Reserve's monetary policy meeting. The FOMC met and took the decision to hike rate by another 25 basis point and have taken now the upper bound for Fed rate to 5.25. And this chart actually shows you the market expectations prior to the Fed meet and obviously post the FOMC meet. So if you look at it prior to this meeting, I think broadly the markets had penciled in a certain rate hike by the Federal Reserve, in spite of the fact that we've seen some degree of turmoil in the financial markets with what happened to the U.S. banking sector, and obviously culminated in disappearance of the Credit Suisse First Bank. But prior to the Fed meet, I guess the expectation was still sort of around the fact that there will be rate cuts going forward, but maybe a little bit slower. In fact, if you look at the expectation of what could be the policy rate by, say, end of this year, they were gearing more around 4 quarter or thereabouts. But when you look at the sort of commentary that came in out of the the FOMC meet by the US Fed governor, the market expectations actually changed pretty dramatically. In fact, post policy meet, the markets are now not looking at any rate hikes at all by the Fed. In fact, their expectation of both pace and the extent of rate cuts by the Federal Reserve has accelerated, where as early as July 26th, they are actually penciling in a potential rate cut, taking the rates all the way down to 4% by end of the year. So, in fact, if you look at what the US markets are currently projecting in terms of the Fed rate, they're looking at maybe a pause in the next meeting on 14th June and a rate cut beginning in the 26th July meet. And subsequent, every meet will see a potential 25 basis point rate cut and taking down the Federal Reserve, the Fed rate from 5.25 to 4% by end of the year. So, in some ways, the US markets are already indicating that the peak rate has been reached. No further expectations from the Federal Reserve, which is also somewhat supportive of the global bond rally that we've seen, especially in the month of May post the FOMC policy rate announcement. If you look at another notable feature, how the markets are really looking at so-called peak Fed rate, I think it's clearly reflected in the way the dollar has been weakening. In the earlier phase, when the rate hike cycle began, the aggressive rate hikes actually, did support the US dollar to a large extent. And the moment, I guess, markets started sort of looking at a terminal rate or maybe end to the rate hiking cycle, the dollar has been somewhat weak. Particularly in the last, I would say, few months, you would note that there has been a meaningful decline as far as the dollar index is concerned, because I guess the expectation of a pause by the U.S. Federal Reserve followed by a potential rate cut going forward will no longer support any strengthening of the dollar, which is again positive for Indian rupee. So a quick summary of, I guess, where the yields have moved over the previous month and also on a year-on-year basis. I think what's notable here is that over the month of April over March, we've seen a broad-based decline as far as the benchmark yields are concerned across the Western economies, LATAM, even in Asia Pacific region, including India as well. The only exception here, like I mentioned earlier, is UK, where the inflation continues to be fairly stubborn. And as recently as the meeting which BOE held just a day ago, they've hiked the rates and have actually indicated they may have to hike rates again. So the only outlier in terms of a country which has not yet seen the peak policy rate and may hike maybe once or twice more is UK, and a potential rate hike is also expected as far as the ECB, the European Central Bank, is concerned. So that's a quick snapshot and summary of what's happening on the global front. Now let's come back to India. When you look at the trends in India in terms of growth, I think the growth expectations are fairly strong, and this is reflected in the official estimates of GDP. They've actually been revised upwards in the April policy meet that RBI, announced, and we are now looking at, an average FY24 GDP growth rate of 6.5%, which, when you place it with what the EM average is sort of indicated by IMF at about 4.4%, clearly indicates that we will remain one of the fastest growing economies within the emerging market or developing market space. And while the average growth is strong, but there is clearly a big base effect for Q1, and then it sort of mellows down to an average of about 6 odd percent. This is something, I guess, which markets participants are looking at very closely, because the market expectations, I guess, in terms of the GDP growth rates are somewhat lower than what the official forecast currently stand. Uh, Clearly, the concerns why markets feel that the Indian economy could grow somewhat lower than this are more sort of revolving around the fact that we've seen a fairly significant pent-up demand creeping into strong GDP numbers, consumption demand. But as rates, trickle through in terms of the rate hikes which RBI has done, it may curb some degree of consumption demand. It may also lead to a bit of a decline in some of the services sector, including credit growth. And that, I think, possibly coupled with the fact that when the global developed economies are slowing down, can also impact our exports. And hence, possibly there could be some downside risk to the overall GDP estimates at the present juncture. Moving on to inflation, I guess a very similar trend that we talked about for the global economies. Inflation is trending down, clearly significant decline from the peak we've seen. One notable feature for India clearly has been the fact that our inflation trends, at least over the recent few months, and the kind of forecast that RBI has projected over the next 4 quarters, indicates that we will average inflation just about 5% odd, which clearly is a significant benefit for investors in fixed income markets, because with the policy rate at 6.5, with inflation trending around 5 odd percent, even the policy rate spread is now significantly positive. So as of now, if you look at the trend from the peaks, or at least the early above 6% numbers we had seen for the month of Jan and Feb, it did decline very sharply. The expectation is that the print that we may see, after today's business hours, could be even below 5%. That's to some extent influenced by a very high base effect for the same month last year, and also the broader momentum that's clearly showing a decline month on month. So the benefit will be reflected in in the Q1 CPI estimates for India, trending maybe 5 or sub 5%, which will augur very well for the interest rate outlook. And inflation in India is actually, if you look at the two parameters, both CPI and WPI, both of them are showing a very sort of a similar downward sloping trend. WPI, as we talked about earlier as well, is significantly influenced by commodity prices, and we've seen a meaningful decline. And it's quite likely that you could, maybe even see WPI sort of ending into a disinflation phase where you see negative numbers on a month-on-month basis. So let's wait and watch for that. The concern, I guess, is that while we are seeing a decline in headline inflation, the core still remains somewhat sticky and very close to 6 odd percent. It's seen some degree of decline, and there is an expectation that as the headline inflation declines into the rest of this financial year, even the core CPI should see some extent of slowdown. We will have to wait and watch to see how meaningful it is, because that really is one area of concern. The other area of concern, as far as India's inflation print is concerned, is also around the fact that we have a few uncertainties around how the food prices behave, particularly since there has been some initial signs of warning as far as monsoons are concerned, particularly related to El Nino and its impact on the weather disruption that we may see. So this is something to closely watch out for. As you're aware, food has a very large component of our CPI index, and any adverse price movement, the prices of cereals, vegetables, and a few specific commodities can have a meaningful impact on the headline inflation, which could possibly put the central bank on on a extended pause and maybe even make them a bit concerned. So that's the story as far as India's inflation is concerned. When you look at liquidity, we've been talking about this since beginning of this year, that part of the strategy by RBI in hiking rates is also to reduce systemic liquidity. And that again, to some extent, is more a reflection of the fact that they need to make the repo rate as their de facto policy rate. So moderation is an expected trend. We expect it to continue to remain somewhat range bound. In fact, we've seen the numbers dip very close to sort of almost something like 500 odd billion to 800 odd billion a day, sort of what we call as sustainable liquidity in the system. And I think that sort of a number will keep appearing every now and then. There are some concerns in terms of what we could see in terms of the broader outlook on liquidity. There is a typical uh, increase as far as outflow of currency is concerned. We've not seen any meaningful FX intervention. It was not required because rupee has been fairly stable. But if there were to be any pressure on rupee and RBI is forced to intervene to support the currency, then that can also lead to some extent of decline in the system liquidity. But broadly, I guess you will see sort of the liquidity in the system following a very similar pattern where it wavers between maybe 500 odd billion to maybe a trillion odd rupees of sort of systemic liquidity going forward. So this to some extent will impact a little bit at the short end of the curve, but again not meaningfully so, because I guess the key driver of short-term rates will still be driven by expectation of the repo rate going forward. When you look at the market's reaction to what's been taking place over the last month, I guess no significant change. We've been talking about this flattening of the yield curve for quite some time. It hasn't really changed the contours over the last few months, in spite of the latest pause by RBI in the April policy meet. We've seen a sort of a parallel shift downwards, but the shape of the curve still remains very flat. And I think what will really lead to some degree of steepness will be when the rate cuts by RBI actually begin. Till then, I guess, when you look at this shape of the curve, it really doesn't give you any added benefit of going long on duration. So just to give you a perspective, if you were investing in a 2-year bond, you would be earning maybe just about 6.95 or thereabout levels. And when you go back right up to 40-year G-Secs, you get about 7.17. So it's just a delta of, barely 20 odd basis point across the entire spectrum. So adding duration is not really yielding you anything significant in terms of the actual carry of the yield. April clearly was positive broadly across the board for rates, and this was largely on the backdrop of RBI's pause, which was a bit of a I would say non-consensus outcome. I think markets went into the April policy meeting expecting maybe one more rate hike, given some of the leading concerns into it. And the outcome was, I guess, quite a big surprise. So we've seen some bit of a rally. A large part of the rally, I think, was seen more at in the sort of the benchmark 10-year G-Secs. But across the board, whether you look at 1, 3, 5-year G-Secs, all of them did see a decline over where they were in March. What's notable here is that obviously the flatness is reflected when you look at the G-Sec yields across different segments between where they were 1 year ago in April 22 and where they are in April 23. But if you look at the 10-year, you would note that the 10-year G-Sec yield actually is marginally lower than where we were same month last year. So that is another reflection of the flatness of the curve. But when you look at the corporate bond segment, again a marked decline. Clearly not as significant a decline at the short end in the 1-year rates, but as you move up the maturity bucket, you start seeing, the decline being ranging between 15 to as high as 25 odd basis point. So that's really the nature of how the markets have reacted. Like I said, the biggest event which drove this was obviously RBI policy meeting, and I'll just come to that briefly. Valuation, I guess, when you look at the spreads for a AAA 3 year bond versus, and even for a 1 year, money market CD rates, they're not significantly expensive or cheap. They're kind of middling around longer term averages. In fact, the 3 year AAA PSU bond has moved below the longer term average spreads of about 138 basis point, but the CD rates still remain somewhat at the averages. So some of this decline is obviously a reflection of an expectation by the Indian fixed income investors as well that we may have reached the terminal rate. And as far as the repo rate is concerned, one may not see any meaningful changes in terms of rate hikes here on. The other notable, I guess, event driving domestic interest rates clearly has been for the sovereign bonds, the borrowing calendar. There was a meaningful shift as far as the pattern of the borrowing is concerned. If you look at this table, this actually shows you the pattern of borrowing that existed for the same 6 month period last year and where it stands as of this year. Some of the key takeaways clearly are in the fact that we've seen a decline of the 5 year and no borrowing as far as the floating rate bonds are concerned. So that to some extent has helped those segments outperform recently. But there has been a shift in terms of the quantum of borrowing towards the longer end. So you would note that while the 10 year anyway does see a very similar percentage of borrowing of the total at 20%, but at the long end, when you start looking at the 14, 30, and 40 year segment, it's actually moved up by at least 2 percentage points and even 4 percentage points for the 40 year segment, clearly indicating that there is meaningful appetite in that segment, and maybe based on the feedback, uh, uh, RBI and the government of India decided to issue relatively more bonds in that segment. In fact, there was an early expectation by the markets that seeing such a large supply at the long end, one could potentially see the curve steepen a bit. But I guess the demand has been fairly strong. Most of the auctions have been cleared at fairly aggressive levels. We've not really seen that degree of steepness taking place in the 15 to 40 sort of a segment. So that's where GSEC markets are. Coming to the most important event that took place in April was obviously RBI's monetary policy, and like I mentioned, this was a bit of a non-consensus decision where they kept the rates unchanged. However, they did maintain their policy stance of withdrawal of accommodation, and I think this is largely on the back of the fact that they were looking at softening of headline inflation. There was a bit of global financial market turmoil, which also would have maybe crept into their decision making. But they did not want to close the door on any potential rate hike if the data point was to deteriorate, or if their current outlook in terms of inflation guidance that they provided was to move to the contrary. So I guess they did specify that the pause, if any, was only for this meeting, and whatever happens in the next policy meeting will be decided based on incremental data and whatever trends they witness. So I suppose to that extent, it was a fairly dovish policy meeting. We did have a call just after the policy, so I hope a lot of those opinions and views that we had were expressed, and I do hope that you got a chance to join and hear our investment team talk about it. Uh, I think when it comes to the way forward, the expectations right now of any further rate hikes by RBI are very, very low. I think nobody expects RBI to do anything more in terms of shifting their policy rate from here on. So one could argue that we may have actually reached the terminal or the peak policy rate. In fact, just the way we talked about the US, Fed futures and the US futures market indicating rate cuts by the Federal Reserve, a very similar pattern is also emerging for India, where people have started now penciling in the next move after maybe an extended pause, going towards rate cuts by RBI. So I guess from our perspective, while we don't discount potential rate cut by RBI, we think it's a little too early to start building in that scenario. Like I mentioned, there are still some uncertainties around inflation path going forward, and the fact that none of the central banks have conclusively stated that they have ended their rate hiking cycle. So I suppose most of them will remain data dependent. And while we've had some benefits of inflation coming down, commodity prices coming down, even crude has come off significantly, and trended almost close to 72 odd dollars to a barrel. But any reversal of these trends can actually again start reflecting into inflation guidance or inflation outlook, which will make any preemptive or an early expectations of rate cuts from RBI a bit premature. So we generally hold the view that it will be best strategy for RBI to remain on an extended pause, wait and watch how the global policy rate sort of play out, whether inflation as it comes down to, like I said, 5 odd %, which is the current estimate, really remains sustainable, or is it just, statistical sort of event, and there are no upside risks to that. It's only when you have certain prerequisites or at least conviction around some of these, conditions, will RBI like to and should go ahead with any easing. But I guess rate cuts are inevitable. It's just a matter of time, whether it happens over the next 6 months, 12 months, or 18 months. The direction clearly for rates is that they will start trending down, because most of the drivers, as far as policy rates are concerned, are favoring no further rate hikes and no potential easing going forward. So with that, maybe just a quick roundup and summarizing what are the key takeaways that we have. So to start out with, clearly there are expectations that aggregate demand and hence inflation will start moderating. This has largely been driven by a very aggressive and front loading of rate hikes, which has in some ways tried to address the sort of strong growth, which is a prerequisite for bringing inflation down, and that's reflected in growth outlook actually declining over the previous years. Like I mentioned, the probability of further rate hikes are very low. In fact, the data will really have to surprise adversely for RBI to consider any incremental action, which means that if inflation really goes back to 6 or above 6 sort of levels and sort of stays above those levels for a sustained period of time, is when maybe RBI will have to reconsider the current pause. I already mentioned about the fact that the prerequisite for any pivot or any reversal of the current pause from RBI will depend on a more sustainable decline in inflation. We think you could see the supply being a material sort of driver of how the rates behave, while a pause is given and it's already priced in. In fact, markets, I would say, are almost pricing in a 50 basis point rate cut by RBI. But the supply, I guess, will not allow any significant rally in the benchmark yields, including uh, sort of G6 even in the sort of 5 and 15-year segment. If you look at market expecting maybe 50 basis point rate cut, which I think is fair to assume, because if we are going to see inflations around 5%, then a policy rate of 6% is sustainable, which means that the 10-year GSEC at 7% looks fairly priced. Anything meaningfully above 715, 725 kind of levels can make the benchmark a bit attractive. But again, because we will continue to see a meaningful supply, if you look at what I talked about, a significant jump in the issuance size in the 10-year segment, it's unlikely that you can actually see a meaningful decline in the benchmark without expectations or without RBI actually affecting more rate cuts from what's already priced in. So, given this sort of a backdrop, we've been in fact saying it now consistently for last 4 months that the environment for interest rates is turning a lot more positive. We believe fixed income is now coming back into play for investors where they're earning a real rate of return. They should focus on appropriate strategies, appropriate investment horizons to get benefit of what we think will play out over the next few years. So if you have an investment horizon of 6 to 12 months, look at low duration money market kind of products. With longer term, look at steady accrual with a bit of a duration play in the 1 to 4 year categories. And again, if you looked at the key drivers, clearly the four key drivers remain: interest rates are peak. We have real positive rates for investors. There's also opportunity to capture high nominal rates by locking in, and obviously, gains from potential rate cuts. So these are the four key drivers which we think will keep debt investments attractive for investors and should be part of your investment portfolio. This number actually shows you how, the real rates have been. So after almost 3 consecutive years, we are actually seeing just on a 1 year forward outlook in terms of the 1 year yield less the inflation expectations, giving you almost over 200 basis point. That's very attractive, from an investment perspective. And even if you look at slightly, medium term outlook on inflation, earning about 7, 7.5 sort of a band between what maturity you look at over an inflation which could at best revert to 5.5 level, still sort of protects your capital and gives you a decent real rate of return. So that's really the crux of looking at fixed income, funds right now. One of the questions which has obviously been coming up, and I'm sure will also be on top of your mind, has been around the changes in the taxation guidelines for fixed income funds. And this is something that we've been saying again and again at all forums, and I will, at the cost of repetition, again highlight some of the benefits which really should outweigh the concerns that investors have around the fact that indexation benefits are gone. Fixed income funds actually have certain core benefits which you have to focus on. And this has been sort of sustainable and have been around for many, many years. And you've seen a meaningful impact or benefit from some of these, benefits that, clearly do outweigh any changes in the taxation that we've seen. So, and we have a very long track record in history, as far as fixed income funds are concerned. So if you have to sort of list it out, I'll say the biggest benefit that you can actually capture in from a fund, an open-ended fixed income fund, over just holding on to a fixed rate bond or a deposit, is the fact that you can actually benefit in a falling interest rate scenario, right? The MTM gains can be significant and meaningful for you to stay invested in a debt fund, and that is very important. And as we've already highlighted, clearly we are at that phase of a cycle where over the next 18 to 24 months you could see rates coming down, and if you stay invested you can actually benefit from the gains that you can get from sort of the valuation moving up whenever the rates move down. Of course, the other benefits are clearly more generic and structural to fixed income funds: professional management who will change duration, who will play across different asset classes, whether it's money market, corporate bonds, or G-SECs, to benefit from either the carry, accrual, or spreads. This is something which can add a bit more to your overall return profile. The diversification that a mutual fund offers, you don't have to stay invested in one single instrument or one single, say, issuer of a deposit, and you can actually diversify your investments across a much wider spectrum of issuers and sectors. The transparency and flexibility clearly are benefits that a mutual fund offers you. You have full disclosure of the portfolios, the portfolio statistics, which will help you assess the risk and the potential return profile of a fund. The fact that you have easy liquidity of a fund, you can actually redeem, on any given day. In fact, most of the fixed income funds do not have exit loads, or if they do, they have it for a very short period of time, like a liquid, cash plan. But the liquidity that's available for you under any, requirement is a significant positive that does help investors in mutual funds. And the final benefit, which I think is also very important, that when you look at coming into, let's say, a growth plan of a debt fund, you get twin benefits. One, you can actually plan your tax outgo based on when you want to redeem, and you want to pay that tax. It's not natural, it's not annual, it's not sort of dependent on the underlying instrument or underlying deposit. It's purely in your hands, where you can decide which year and how long you want to retain the deferral of that tax. And the second benefit that you get typically in a mutual fund portfolio is the fact that you get compounding benefits, because even the interest that you earn is not taxed in your hands, but that actually gets reinvested within the portfolio, and hence earns interest. So that does give you a few basis point of extra return. So these are some of the benefits that we've been continuously highlighting and saying that don't get scared of the fact that indexation benefits have gone. I think there are enough benefits of debt funds which far outweigh what you think you may have lost. So I think in that backdrop, given the environment that we talked about, we do have you know yeah. So clearly, in this sort of a backdrop, we do feel staying invested in fixed income funds are appropriate for investors. And please do choose the type of product and the maturity bucket that you want to stay invested in based on your risk profile. So from UTI's perspective, we've articulated 4 funds in different maturity buckets. And it's very important that when you look at any of these products, it should align with your investment horizon, because that's really the underlying duration that these funds are running. So for something less than 1 year, we do recommend our UTI Ultra Short Term Fund. For 1 to 3 years, UTI Short Term Income Fund. For 3+ years, we are recommending our UTI Banking and PSU Debt Fund. And finally, for somebody who wants to stay invested for more than 5 years, wants to maybe capture a bit of MTM gain, but wants a very high investment grade portfolio, the UTI CRISIL SDL Maturity Target Date Index Fund. A quick recap of the benefits. I think when you look at the ultra short-term fund, the key benefit that we've always been highlighting is the fact that it gives you a much higher return than the liquid funds. Particularly, when you look at the fact that the spread over a liquid fund on an index to index comparison is almost 50 odd basis point on an average. And especially when you stay invested for 3 to 6 months, I think that's an extremely good rationale for parking your short-term surpluses or the liquidity that you may have pending deployment in other asset classes. Could be equity, could be real estate, could be gold, or wherever else you may want to deploy that money eventually. But why not look to earn maybe a couple of 100 basis point over a savings bank rate, maybe 50 basis point even over a traditional liquid fund. So I guess that's really the key driver of ultra short-term fund. When you look at the short-term income fund, again, this is a product which we are recommending for 1 to 3 years. And when you look at the return profile of 3-year short-term index, bond index, you would note that on an average it's given a decent 8% kind of return. And over any 3-year rolling period, it's not given you a negative return. So that's really a big driver of trying to enhance the return profile of your overall fixed income portfolio. And when you look at the short-term bond index over a 3-year period, in fact, 98% of the times it has actually given you more than 120 basis point typical liquid fund index, right? So that's a meaningful delta and excess return that you can generate. The UTI Banking and PSU Debt Fund, again, is what we call as a passive strategy. This is something where you can look at focusing more on the actual accrual. So this is something we are recommending for investors with a 3+ investment horizon. It follows a roll down strategy where the entire portfolio will mature around a specific maturity period, which is first quarter of FY27. And there is no addition of duration, and there are no MTM sort of risks over here, because the progressively, as you look at month on month in terms of the duration and average maturity of the fund, it keeps declining. And that's really the nature of the strategy that's followed in this fund. In terms of the portfolio quality, again, it's a very high investment grade portfolio, 100% allocation to AAAs, largely focused on the banking sector issuers and public sector undertakings. So, a very high quality investment portfolio, no investments in any perpetual bonds or tier two, bank bonds. Finally, we talk about UTI's targeted index fund. Again, this is at the present juncture, it has a residual life of just about 10 odd years. And this is something which, again, is a product suitable for investors who either want to just stay invested for that longer duration and want to lock in at the present levels. Alternately, it can also be used tactically by investors who feel that they would, maybe stay invested for 2 to 3 years to play out this interest rate cycle and then, maybe exit. So just capturing in a bit of accrual and a bit of capital gains. So that sort of is again a product which is investing only in state government, bonds, very high investment grade portfolio, almost sovereign, and a very liquid portfolio with well diversified issuers. We focus only on the top 10 liquid SDLs issued by different states. So that sort of also ensures that not only are we investing in a very liquid portfolio, but we're also able to add and exit from positions in the fund. So that was my overall snapshot and overview of the fixed income markets. So with this, I will pause over here and hand it over to my colleague Sonal, and we can maybe start taking in questions here.
Thank you, Amandeep, for sharing the insights on the market, what had happened in the month of April. And like you rightly said, rightly highlighted on the merits of fixed income mutual funds over any other alternatives. In fact, the change of taxation hasn't really changed the flows in this space, with fixed income mutual funds garnering over 80,000 crores in the month of April. So, fixed income does have multiple merits with no plethora of alternatives that options to choose from for the investors. So, moving on to the question and answers. First question that we have here is, like you mentioned, that RBI might take a long pause from here before it pivots. How do you really see the movement of yields in the short term and the long term papers when the pivot really happens till such time? Over to you.
Sure. That's, I think, a very good question. Thank you for that. Our expectation is that ideally RBI should wait for at least 3 quarters to see how the inflation trajectory really plays out, because there is clearly a big event, which is the monsoons, which can impact food prices significantly. So trying to preempt any of those events would not be in interest of the inflation credential that RBI is projecting. So I suppose our expectation is they'll remain on a pause. When they do pivot, it's very clear that markets will start now building in expectation of what is the extent of rate cuts that RBI can do. So in the near term, I guess the short end will react more to each rate cut. But the long end, I guess, will start pricing in a little bit more in terms of how many rate cuts can we see. Is it 2? Is it 3? Like I said, at the present juncture, I think 2 rate cuts are already discounted. So the 10-year at 7.705 is fairly reflecting that sort of a trend. If markets start building in maybe 1 or 2 more rate cuts going forward, then one can potentially see the 10-year react a lot more. But at the short end, which is the 1 and 2 year segment, I would think it will largely react more to the actual overnight or the policy rate, right? You could also see a meaningful rally in the 5-year. So essentially, anything from 3 to 10-year segment is more likely to react, but in different, proportions to the expectation of rate cuts. But anything from a 3-month T-bill to maybe even a 1 year or a 2 year segment will react more to the actual overnight trade.
Sure. So moving on to the next questions, now that the interest rates looks like they have really peaked out. So what are your views on the credit growth as the numbers were good when the interest rates were rising? So how do you see banks borrowing trajectory for this financial year?
Right. Again, a very good question. I guess, clearly, when you look at longer term trends, a strong GDP and, is actually the key driver of credit growth, right? We've actually seen a good FY22 and even expectation of 23 are fairly strong. So one can see a reasonably good credit growth even in the current year. But clearly, the kind of numbers and the pace that we've seen in the last year may not sustain. And there are two reasons for that. One is just the plain vanilla when you look at both nominal GDP for current year, even expecting a 6.5 sort of a real GDP, and the budget estimates that we saw were more around, 11 odd percent. So I guess nominal GDP itself is declining over what we saw last year. So that is one of the drivers. The second, I guess you're right in assessing the fact that the rate hikes that we've seen are mostly transmitted and somewhat are still being transmitted into the economy. So as we see a good part of that, impacting some of the lending rates, it will start curbing some of the consumption demand. As you're aware, a high pace of consumption is also inflationary to some extent. So that sort of keeps, prices up. So the moment we start seeing some of these higher rates hitting, consumption demand, it'll address two issues. One, some of the core inflation, the pricing power which the manufacturers have displayed, given the strong surge of consumption, will start declining, and hence we can see some more benefits on inflation. On the other side, the higher rates would also mean lesser propensity to borrow and consume. That may lead to some degree of slowdown as far as credit growth is concerned. So yes, if let's say we were to see any further downward revision in GDP outlook, then I guess the slowdown in credit growth could be a little faster than what the current numbers are penciling. But if you, I guess, ask any banker, I guess all of them are projecting a much lower or slower, I would say, credit growth than what we witnessed in the last financial year. So which should also mean that banks would need to borrow that much less going forward. And anyway, they have built in a significant buffer of GSECs. Most of them are holding excess SLR at a system level and may actually resort to other means to raise resources if, let's say, there were some mismatches in their resources versus credit growth.
Sure. So the next question is one of the hot topics on the global front. Since countries like India and other emerging economies, and particularly in India, have increased, the import of oil from Russia's in non-dollar currencies. And in fact, most of the current countries are now calling for trades to be carried out in, in other currencies besides US dollar. In fact, there's a discussion maybe supposed to happen in BRICS countries meeting also, on some common currencies other than USD. So, how do you see it? It looks like most of the central banks and countries are moving towards de-dollarization to reduce dependence on the dollar and buy more gold. But RBI has drastically reduced its gold purchases. So, what is your view on de-dollarization and the gold? No.
So I don't claim to be an expert, on global central banks, but you're right. I mean, clearly, de-dollarization is a concept and is a very hot subject right now. There are multiple reasons why it's become center stage, particularly after the Russia-Ukraine war. So to some extent, yes, some of the central banks seem to be de-risking and moving away from dollar deposits and dollar reserves. But I would still argue that, we're not so sure whether this is really a more structural shift in terms of the strategies followed by different central banks, or it is more typical for certain economies who are in some ways in conflict with the US, whether it's trade conflict in the case of China, or it's in the form of, more embargo and other such conflicts or financial, restrictions that have been imposed, say, for a country like Russia. So we're not so sure whether this is really a more global phenomenon. We'll need to wait and watch how this plays out. But it is not so easy for the global economy to sort of shift away significantly from dollar. It still remains, given the large reserves and sort of the benchmarking which most of the traders and exporters, importers do against the US dollar, still remains pretty much an anchor as far as global trade is concerned. So one could see some decline in its dominance of global trade going forward, but it'll take a lot of time for other currencies to sort of take place, whether it's the Chinese renminbi, clearly, the euro and UK pound have not yet been able to keep pace. So one really needs to wait and watch. But yes, it is clearly an event which will be closely tracked by the financial markets.
Sure. So other question also is on a global economy. So there is a lot of talk going on the debt ceiling limits of US economy. So how grave is this problem, and do you really foresee a default? No, in fact, in developed economies such as US, can it really default? And what if so happen? What would be the implications on Indian bond markets?
Yes. So that I think, let me start by saying that a default by US on its debt obligations would really be sort of the black swan event, which everybody can see, but nobody would want, to happen. So to some extent, as you're aware, the federal government in US runs very large deficits, just like, many other economies. And most of this is funded out of debt, which is raised domestically and overseas, where, global central banks, even RBI, would be subscribing to the bonds issued by the US government, the US Treasury bills. Now, what typically happens is that, as you're aware, the deficit continues to increase, particularly in the post-COVID environment where, there were significant deficits built up. So as per law, there is a ceiling, there is a specific amount that the government can borrow. And that's in a way a disciplinary method where, it sort of ensures that the government takes efforts to increase revenues so that it doesn't have to borrow above a certain level. At the same time, it also then has to curb certain expenditure, maybe, reduce certain stimulus or subsidies, etc., such that, it can balance its budget and doesn't have to borrow more than a specific amount. To give an analogy for India, I mean, it would be, let's say, if there was a very sort of hard rule that your fiscal deficit cannot be, let's say, more than 3%. And that's it. I mean, you just cannot go above that, which would mean that the government will actually have to then ensure that either its tax revenues go up so that, it can meet its deficits by borrowing just up to 3% of GDP, or alternately, it'll have to curb its expenditure significantly to ensure that, the numbers don't breach. So that is the state US is right now. Typically, these limits are revised based on approval by the Senate, and clearly there is bipartisan policy out over here. The Republicans are not agreeing to any dispensation. But the sense, I guess, if you look at global markets behavior, they're not really taking it as a significant risk. I think everybody believes that this is going to be a game of brinkmanship where they will fight it out. There'll be a bit of give and take, but eventually the debt ceiling will be raised. If you recall, there were two such episodes earlier as well, both during Obama's time, during Trump's time, where the debt ceiling had sort of almost reached, and there was a state of I would say disagreement between the two political parties in the US, where the government actually stopped spending, so they stopped paying their employees. There was garbage lying on the street that could not be picked up because there was no money to meet various expenditure of the state governments, and hence you had a lot of such issues. But eventually they agreed to increasing the limit, and hence the government could borrow more, get additional funds, and could meet the expenditure required. So I guess when you look at some of the statements coming out, by the financial press, which is quite honestly my source of information as well, it doesn't seem like anyone is concerned that this will break through and the US will actually default, because that will have very serious ramifications. Just imagine, a rating of US actually going down, that will impact the currency, will definitely lead to a lot of selling of their bonds, the treasuries, which in turn will mean that you could also see a bit of liquidity squeeze globally, and hence there will be peripheral repercussions on Indian bond markets. Clearly there will be a bit of risk off, and people will start moving money out of maybe some of the more dollar dependent economies like ours, and you could have many other such implications. So it is an event which, quite honestly, we really don't have a fix for, and you really can't de-risk yourself from it either. The expectation is that sense will prevail, and there will be some outcome. So in the past, if you recall, it's always ended with by saying, okay, this year we'll let you borrow more, but next year please bring your expenditure down. Please try and reduce maybe some of the tax benefits you've given and increase your tax revenues. So my sense is that maybe it will follow a similar path.
Oh, thank you so much for such an elaborate answer to this question. Considering the paucity of time, we will take one more question. And I would like to request our viewers to do share your feedback. There is a link on your screen. So do your share your feedback before you log off for the day. For the last question, it's like, what are your views on taking credit risk at this juncture? Are the risk reward favorable in the credit space?
So I would say that yes, the credit environment is somewhat more benign. Unfortunately, like I've mentioned this in the earlier sort of market insight presentations as well, we have not yet seen the spreads really increase to a level where taking a bit of credit risk is sort of gives you a reasonable risk reward benefit. I think that environment is now turning, because we are seeing, as in one of the slides I've shown you, how the AA rates have moved. So in terms of the spread over a sovereign bond, or even the spread over a AAA bond, we are seeing some signs of that returning. So at a level, it will become attractive. So just like I've always been saying, when it comes to fixed income investments, don't put all your eggs in one basket. Similarly, you have to have some allocation in credit risk category also. At the present juncture, maybe this is a time to start maybe putting in some money over here, a small amount. And I would never recommend having a credit risk fund exposure in your overall fixed income fund portfolio of more than 10%. So as and when these spreads become attractive, so the typical YTM of, let's say, a credit risk fund nears 875, 9 odd levels, that is, I think, when the product will become much more attractive and suitable for investors. Because in a low risk AAA bond portfolio, whether it's a short term income or corporate bond fund of UTI, you already are getting about 7.5, right? So you need at least 100 basis point over and above that to make that segment attractive and worthwhile.
So thank you so very much, Mr. Amandeep, for your insights. And I hope our viewers are taking quite some valuable knowledge from this session today. Thank you for watching this platform. And thank you, Amandeep. We can close up together.
Thank you, everyone. Look forward to the next month.
Sure.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.